Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith. Let's get to the three things that you need to know today. First up, U.S. stock futures wavering this morning as traders await a decision on whether the U.S. will intervene in the Israel-Iran conflict. In the commodities market, oil prices fell as traders were expecting a decision sooner from the White House. And in corporate news, American Airlines and United Airlines are pausing some flights to the Middle East and the conflict that continues to go on here, while the CEO of Shell is warning of a huge impact that should the Strait of Hormuz be blocked. Investors also watching the options market today amid the quarterly triple witching, where we're watching for $6.5 trillion in U.S. stock options to expire. The event could open the path to more sudden stock market moves next week, but Wall Street strategists remain bullish. Analysts at Citibank maintaining their overweight view on stocks and expect the impact of the Middle East conflict on risk assets to be short-lived. And Tesla launching its robo-taxi this weekend in Austin, Texas. The launch will be small, with a limited number of cars and human teleoperators ready to intervene if self-driving cars and cabs run into problems. Investors should also expect the cabs to operate in limited areas. That's still too big for Texas Democrats, who have asked Tesla to delay the launch until September. U.S. stock futures this morning moving ever so slightly to the upside as traders assess the risks of the Middle East conflict. Citi strategists remain bullish on stocks as they expect to hit risk assets to be short-lived here. Joining us now, we've got Yahoo Finance markets correspondent Josh Schaefer. Josh, what do we know here? What's Citi looking out for?
Yeah, Brad, I mean, it seems like Citi has sort of been reiterating this call relatively consistently, right? Essentially arguing that if those conflicts are short-lived, then they're not going to be that big of an issue for the market, right? We know several strategy teams on Wall Street have really just been looking at the impact on oil, right? And looking at both the prices on oil and essentially arguing that if we're at where we have been recently at about $75 a barrel, if we don't get higher to maybe 90, if we're not going into the hundreds, then that would be where there'd start to be concerns, right? We had talked to one strategist who had highlighted $120 a barrel was a key point. That was Nick Colas over at DataTrack. He published that recently in research, saying $120, basically a doubling of where oil was from a year ago, would be the key concern. Of course, that's about $50 more per barrel. You're seeing that on your screen right now. So that would be sort of a key concern, but it just doesn't seem like we're getting there to this point in terms of that Middle East conflict.
And so with that in mind, as we're continuing to track how this is also influencing some of the year-end targets, does it seem like there's any spillover, at least at this moment right now, for projections?
No, I mean, it seems like right now the year-end target is the same story as really the market as a whole, right? Which is everything sort of moved 2 or 3 weeks ago, and now it's been a lot of wait and see, right? So you have some strategists, like we had Deutsche Bank's Vicky Chadha on recently. I think his target's sitting around 6,500. He was talking to potential upside risks, right? Potential downside risks. And he said, there's perhaps a lot of upside risks in terms of could the economy actually do better than we think? Could the growth that you saw in those Fed funds forecasts from last week, right? I think it's Monday because we had yesterday out.
It's
from
a repeat
Wednesday,
Friday.
From Wednesday, right? You saw the Fed downgrade their growth forecast, right? But what if instead of downgrading growth forecasts, we go back to upgrading growth forecasts? Then would more targets come higher? That seems to be one of the key questions. But whether it's the Fed, whether it's the Middle East conflict, it seems like it's still in large part wait and see. Let's see what happens over the next couple weeks. Again, leading into that big July 9th. Perhaps announcement, perhaps not announcement. Maybe the tariffs stay delayed, but that's also on the calendar.
Yeah, with this Groundhog Day workday, it certainly is easy to forget as well that you had a Fed decision this week that the markets, of course, were going to be looking out and into the summary of economic projections, that SEP, to really understand what type of cut propensity we would see from this Fed. And we got a little bit more clarity on that front, but does that change the narrative drastically in terms of the thesis that we're already seeing kind of prevail on Wall Street?
No, Brad, I think what the Fed's summary of economic projections, maybe even looking past the dot plot, right? Sure. So you had a large part of officials argue for 0 cuts and a large part of officials argue for 2 cuts. But what I found most interesting was within the revisions, you had GDP forecast going from 1.7% to 1.4%, right? You You had unemployment coming up from 4.4 to 4.5, core PCE inflation going up from 2.8 to 3.1. That is sort of the story of the economy right now. The fear is inflation could move higher, growth could stagnate, maybe you get stagflation, right? And there's also risks on the employment side. That is the economic narrative entering the summer. And then you have sort of your zero-cut camp and your two-cut camp. Your two-cut camp would be, we get a little bit more concerned about growth, right? Or maybe inflation doesn't go as high as we thought. Your zero-cut camp is inflation goes higher than we thought. And so that is right now exactly where the divide is, where that sort of splits over the next 2 months seems to be the key story as we head into what will likely be perhaps an exciting Jackson Hole this year in August.
Well, I mean, you have Waller out on CNBC interview this morning saying that he doesn't think that we need to wait much longer to cut rates. Is it expected, based on what we saw within the dots, that there might be others in that same camp?
Yeah, oh, for sure, right? I think Waller has been more outspoken, but you look at the dots and you have 7 officials arguing for 2 cuts.
Yeah.
I mean, he's not alone, Brad, right?
It's how aggressive they will be to getting to those cuts.
Right. July, Waller had mentioned July. I mean, July seems perhaps maybe early, right? Because you're only going to get one more inflation report between now and then. You're going to get the June data. And the question is, do you also need the July data? But I think at some point, people are starting to look at the last 2 months. You look at April and May, you're not seeing that big of a spike in the overall inflation data. So at some point, the proof's got to be in the pudding, right? You got to see the numbers go up instead of just expecting the numbers to go up at some point.
Well, and that's what makes the point from Torsten Slok, Apollo chief economist, even more interesting this morning, talking about the CPI data quality declining from what he was assessing and looking across how much of that data, the share of the data that is essentially kind of an estimate versus the hard data that's surveyed and ultimately gathered up. That estimated data increased to 30%. That's one of the highest readings that we've seen in years. So that is certainly going to kind of throw a larger
Jay Powell talked about that on Wednesday too, right? He mentioned specifically that could lead to more volatility in the data. So that will be interesting as we move forward to see how people sort of digest that volatility.
Josh, thanks for coming to work today. Investors are weighing potential U.S. involvement in the Middle East conflict between Iran and Israel. The White House says President Trump will decide whether to get involved within 2 weeks. Iran's foreign minister says the country won't meet with the U.S. for nuclear talks until Israel's strikes on Iran have come to an end. This comes as the Israeli military says it struck dozens of military targets in Iran overnight, including missile manufacturing facilities. European leaders are holding talks with Iran today in Geneva, Switzerland, in an effort to reach a diplomatic solution. So what could U.S. involvement mean for global financial markets? Joining us now, we've got Ed Mills, Raymond James Managing Director. Ed, thanks so much for taking the time here with us on this Friday. You know, just as we're thinking through what any type of intervention may look like and whether it's warranted or not, what is your own assessment?
Yeah, Brad. So what we've been monitoring here at Raymond James is kind of exactly when and how big a strike could be. I think most of the investors that I've talked to are really focused on this nuclear facility that's underground at Fordo. If there is to be U.S. involvement, the most likely outcome there would be the potential use of a bunker buster bomb, taking that out. I don't think that the market is pricing in a longer term conflict. There is always obviously questions about unintended consequences, what comes after that. What we've really seen is a huge shift both by Israel and by President Trump looking at the enrichment activities of Iran in saying enriching to the levels that they are is an unacceptable policy outcome. And now that Israel has had strikes for over a week into Iran, not allowing for the Fordo nuclear facility to continue to enrich is clearly a goal, at least of Israel and probably of the United States as well.
You know, I wonder for what we're continuing to hear out of President Trump, specifically whether that be on social media or whether that be through the other mouthpieces at the White House that are speaking on the behalf of those conversations that are taking place. I wonder how much the markets are looking for just a sense of credibility towards what, even if he is extremely vocal and more so than past presidents at times where we're looking for diplomatic talks to proceed and negotiations to be in kind of a cooler heads prevailing type of way. In this instance, it seems like investors are just trying to sift through what's coming out of the White House and President Trump specifically to figure out what is credible that they can best bake into their own modeling and anticipations at this juncture.
Yeah, Brad, I think you hit on something that's really important. I don't think there is a way to fully assess what Donald Trump is going to do because he himself has said he's not going to know what he does up until the moment he makes that decision. We've seen this time and time again with the Trump administration where you have to expect the unexpected, that the market can get all on one side. I would recount the number of conversations I had here at Raymond James before April 2nd, where everyone thought that was going to be a clearing event and then had a decision that was very different. So I do think what the market is anticipating is that if the United States gets involved, it's going to be limited. It is going to be targeted. But as you mentioned, there is still an opportunity here for diplomatic conversations as well. I think that the true policy goal of the United States right now is to not allow Iran to have the ability to enrich uranium, getting up to anywhere close to kind of weapons grade. And so is that through diplomatic solutions? Is that through a targeted military strike? To me, that's really been the debate that I've been having with clients.
You know, we're essentially 3 weeks away from the tariff pause essentially expiring here. And so we've heard from Treasury Secretary Scott Bessent that it's going to really come down to who's negotiating in good faith. But you have this conflict playing out as we're kind of seeing the clock tick down on those very serious policy negotiations on the tariff front. What are the anticipations that we'd actually see any type of major deal get across the goal line, with this being the prioritization right now at the administration?
Yeah, Brad, isn't it striking that we are here this morning and there are three career, historic, administration-defining events that we are able to discuss? What's happening on tariffs? What's happening with Iran? What's happening with this major tax bill, which is the most expensive bill in the history of the United States? As it relates to tariff, though, Brad, we are looking for more MOUs before that June 8th deadline. We are only kind of have a true MOU or deal signed with the UK, and even the details there are pretty lax. I do anticipate more MOUs to get in place before April 9th. It's only 18 days away. But I do expect there's going to be major parts of the economy globally that don't have MOUs. The EU is right front and center there. And then I also tell investors, do not forget about China. We have had some conversations. There is conflicting information related to what actually happened in Geneva, what happened in London. Are these rare earth minerals starting to flow into the United States? All of my contacts say no. I think we are at the precipice where we're going to see announcements because of the tensions between the United States and China, where industrial capacity here in the United States, especially for autos, in defense, and aerospace, start shutting down as early as this week.
Ed, great to speak with you as always. Thanks so much for taking some time and giving us your analysis and insights on this.
Thank you, Brad.
As President Trump weighs possible U.S. action amid escalating tensions in the Middle East, American companies are making moves of their own. Both American Airlines and United Airlines suspending flights to parts of the region. American has temporarily halted its daily flights to the capital city of Qatar through June 22nd. The move follows a security alert from the U.S. Embassy in Qatar, urging the Americans to exercise increased vigilance and maintain a low profile. The airline says it's monitoring the situation and will adjust operations as needed. Meanwhile, United is pausing daily service from Newark to Dubai. United says it will continue to monitor the situation, and earlier this month, U.S. carriers also paused flights to Tel Aviv after Israel launched airstrikes against Iran. And now, energy giant Shell is warning that a deepening conflict could disrupt global trade, particularly if tensions spill into the Strait of Hormuz. Iran has threatened to block the waterway in the past, and recently ships' communications in the area have been jammed. The strait links the Persian Gulf to the Indian Ocean and carries roughly a quarter of the world's oil supply. Shell CEO says the company has contingency plans in place if conditions deteriorate. We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief. Now time for some of today's trending tickers. We are watching Taiwan Semiconductor, GMS, and Darden Restaurants. First up, Taiwan Semiconductor potentially teaming up with SoftBank's founder on a $1 trillion industrial complex in Arizona to build robots and artificial intelligence. According to reporting from Bloomberg, SoftBank officials want TSMC to play a prominent role in the AI hub, but it's unclear if the company would be interested. TSMC is already building manufacturing facilities in the U.S. with an investment of $165 billion. Next up, GMS facing a potential hostile takeover. Billionaire Brad Jacobs' building products distributor QXO offered to acquire GMS for about $5 billion in cash and says it will proceed with a hostile takeover if the proposal is rejected. According to the Wall Street Journal, Home Depot has also made an offer for GMS. And finally here, Darden Restaurants reporting better than expected fourth quarter results. The Olive Garden owner's sales climbing nearly 11% from a year earlier. The company also forecasting annual same-store sales above estimates and raising its regular quarterly cash dividend to $1.50 per share. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Tesla's robo-taxis are scheduled to roll out in Austin, Texas this weekend, and this after the launch was postponed from earlier this month, with Musk saying that they were being, quote, super paranoid about safety. Joining me now, we've got Ken Johnston, who's the Envorso Vice President of Data, Analytics, and AI. Great to have you here with us this morning. What are you expecting from this launch?
Thanks for having me, Brad. This launch really, in my opinion, is the bold announcement on the next phase of the software-defined vehicle. And what I would say there is Tesla's approach is really around data, and them entering the auto taxi is just the next step for them because they have over 2 million self-driving vehicles on the roads already. So their strategy is about collecting more data, which we know for AI really drives the AI engine, and that gives them a real advantage, and one that I think will ultimately win out over the competition.
You know, we've heard from Elon Musk this year on earnings calls, even at the beginning of the year in Q1, talking about this being a pivotal year for Tesla and specifically talking about some of the major launches that they have, especially with Robotaxi being one of those launches. And of course, its pivot to this narrative of Tesla as an AI company. Where does this sit as a core driver for Tesla's business going forward, and how much should the thinking from the investor standpoint be changed dramatically given what they've endured for the past several years with Tesla really prioritizing automobiles?
Well, that's a great question, Brad, because we've seen Tesla stock take a bit of a hit recently, but they really have positioned themselves to be a technology company. I used to work at Microsoft and then at Ford Motor Company, and you know, their charging technology is now becoming standard for both Ford and GM. That's because they had the better technology. The other OEMs are struggling with their platforms for software-defined vehicles. There's a chance for Tesla to have that technology picked up as well. Tesla is already a technology company. They're just wrapped in a car company. And because of where they're going with the auto taxis, it's giving them an advantage with the data pipeline that they need to be successful in this particular space. So they're really well positioned. And, you know, I'm actually pretty excited about the future of their stock.
And so we also have this deal that it seems like is going to be able to go through, especially considering how they are looking towards battery and making sure that they're manufacturing enough battery going forward too. Tesla's first China grid-scale battery storage station is what we could potentially see coming through, located in Shanghai here. How significant is that, knowing that Elon Musk has said batteries are one of the kind of chief headwinds that they had been facing over the course of this year and trying to produce more rapidly?
Well, batteries are the key piece of technology for all of the OEMs. Ford was investing billions of dollars in our own battery plant and doing deals with China battery manufacturers. So Elon is absolutely right that getting the battery technology and the storage capabilities right is one of the critical things. And that's another area where they're one of the leaders, probably not the biggest leader, but they're really pushing the envelope. And it's the right place to invest. There's also needed investment in getting the raw materials, and Tesla has a whole supply chain where they've managed to do deals to get the lithium that they need for their battery plants. I remember that was a really important thing for us to do at Ford when we were trying to secure the materials we needed for our battery plants. So he's really on track with that and setting the company up for long-term success.
So to bring this conversation full circle here, and knowing that that battery production is going to be key for how many of those batteries can then make their way into either charging facilities for the robo-taxi fleet, and just how many of those robo-taxis would be needed to scale. What does a successful scaling after the launch this weekend look like for Tesla? And what's the checklist that investors should be grading this on?
Well, for me, the biggest checklist for Tesla and also the entire robo-taxi space is safety. And that was one of the things that Tesla cited for the slip in their announcement. And Tesla's at a scale now. I mean, many of us remember some of the early self-driving accidents that happened when Tesla really pushed the technology, but they were a smaller company, a smaller brand. Now safety is paramount. And also with their position in the marketplace, if they have safety issues, it's going to impact not just their entrance into the auto taxi space, it will impact the entire space. So the other competitors, Waymo, Zoox, they actually have to hope that Tesla is successful on the safety front because it will drive opportunity in this market space for them. So that's what I think the real main checklist is. And I already said the next one is scale, and that's where they have an advantage.
And so with that scale, what are the next key areas that they also need to be able to lobby and make sure that they can go beyond what he had talked about on earnings calls, which was California, Texas this year? Then where are we going to see Tesla robo-taxis popping up next? Where does it seem like they have the best inroads?
Well, I mean, we've already seen Vegas is open to it, and it's a very taxi-friendly place. I would think one of the advantages I forgot to mention is I think Waymo, because of their connection with Uber, understands the driving patterns and has access to that graph that Tesla doesn't. So that'll give them a little bit of an advantage in terms of that. But yeah, Vegas, New York. The thing, though, is that I think Tesla's entrance into this space will move us away from a city-by-city and a state-by-state question to now we'll have to take a look at what are the standards we want for auto taxis at a national level. This will really propel that conversation and will create an opportunity for more rapid advancement. And that's actually the opportunity not just for Tesla, but for everybody in this space to finally start to scale their businesses instead of constantly doing one-off pilots by city.
Ken, thanks so much for taking the time here with us this morning.
Thank you so much.
We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief. There you're taking a live look at the opening bells at the New York Stock Exchange and at the NASDAQ. At the NASDAQ, you've got Carver Bank ringing the opening bell. And at the NYSE, you've got Blitz the Barriers ringing the opening bell. Great bell ringers on both sides. There you're taking a look at, let's get some funfetti. Let's go. There it is. There it is. You see the funfetti for this Friday here in Times Square at the NASDAQ. All right, let's take a look at the major averages here as we begin this trading session on a holiday abbreviated trading week here. As we're taking a look at the Dow Jones Industrial Average, we are higher right now, out of the gate by about 0.3%, seeing gains there. NASDAQ Composite also moving to the upside. S&P 500 fractional gains there out of the gate. Want to take a look at the 11 S&P 500 sectors. We've got them dialed up here for you on a heat map, so you don't have to go looking yourself. Take a look at XLY. Yeah, that's your consumer discretionaries. That's moving to the upside by about 0.8% out the gate this morning. All 11 S&P 500 sectors in positive territory right now. Also, let's check in on the NASDAQ 100. A lot of green here on the screen here, but mostly fractional gains. You do have some moves to the upside, more outsized here. Tesla, that's up by about 2.5%. Of course, big weekend for Tesla with the robo-taxi launch, and that is highly anticipated, and investors are going to be watching closely for the rollout more broadly and what scaling looks like, as we were just having a conversation on the morning brief about that. You're also taking a look at the rest of the Mag 7 stocks, all in positive territory right now. Just a few areas of red peppered into the crowd. Let's take a look at who they are. Call them out. Paychex right now, it's down by about 0.3% here. And again, just a handful of some of those decliners in the NASDAQ 100 as of right now. Let's also take a look at the Dow Jones Industrial Average. 30 components here. We got them fired up for you on the screen. IBM, that is down right now by about 1.3%. Biggest laggard of the Dow components. You got just about 5-6 decliners here out of the gate this morning. McDonald's, one of them. Not loving it. It's down 0.1% out of the gate. We'll see if that can get right. Also, Travelers, though, that is leading the pack. It's up by about 1.5%. Also followed by Apple, up 1% right now. Switching gears, let's talk a little oil. Oil falling as investors awaiting a decision on U.S. intervention in Iran. Inez Ferre has the latest. Hello, Inez.
Hey, Brad. Yeah, and just taking a look at where we're at with oil right now, we're looking at WTI that's down about 0.2%. Brent crude is down about 0.6%. You had seen quite a bit of a leg lower earlier this morning. Part of this had to do with President Trump's decision to sort of stay the course for the next 2 weeks and make his decision on Iran within the next 2 weeks. So that really sent futures lower. You also have a report from Reuters that Iran is ready to discuss limitations on their nuclear program. So that has also sent oil lower. But still, if you take a look at the last 5 sessions and the last 3 weeks, oil is on pace for its third week of gains. And I'm going to pull up a year-to-date chart so you can see that oil is almost flat year-to-date when it comes to Brent, just slightly positive, as well as WTI up more than 2.5% when it comes to WTI. Look, Wall Street has been saying that we are seeing about a 10% premium on oil prices right now because of the Israel-Iran conflict. And you have Goldman Sachs, which came out with a note this week that is saying that they're expecting oil prices to go lower in the fourth quarter. Of course, if this conflict doesn't broaden more widely. Also, JP Morgan talking about oil supply shocks and the price shocks that you have from conflicts. Those tend to be short-lived. However, if you see a regime change in an oil-producing country, then you will see prices to the upside for an extended period of time. So a lot is riding on what happens with whether or not the U.S. gets directly involved in the Israel-Iran war. But nonetheless, we're seeing oil that is on pace still for a third week of gains.
All right, Inez, thank you so much for breaking this down. Appreciate it.
Thank you.
It's time now for today's strategy session. Fed Governor Christopher Waller saying he sees a rate cut coming as soon as next month in an interview with CNBC today. So, should investors position for rate cuts sooner rather than later? Joining me now, we've got Seema Shah, Principal Asset Management Chief Global Strategist. Great to see you here this morning with us, Seema, and thanks for taking some time after the opening bell. Just first and foremost, your read into the summary of economic projections and now clearly where at least one of those dots could be represented.
Yeah, good morning. I think the comments are interesting because the summary of economic projections gave a slightly different take on the situation. It showed an upgrade to inflation. It's actually a pretty sharp upgrade in inflation. So with inflation sitting at 2.1% today, they're expecting it to rise to 3% by year end. Powell also talked about rising inflation expectations, concerns that any tariff-driven increase in prices could end up being a little bit more sustained. Now, that was offset with a slight downgrade to growth forecasts. But overall, if you take it all together, the SEP as well as the dot plot, the press conference, if anything, it did shift a little bit hawkish.
And so with that in mind, how should investors be best positioning their own allocations to anticipate the pace at which the Fed might feel comfortable cutting to get to that 50 basis points that the markets had been pricing in by the end of the year?
Well, I think the first thing to say is, whenever we hear from the Fed speak, they still talk about the next move being a downward move. So rate hike's still not on the table, and I think that's key. Investors need to keep that in mind. Our own expectations are that we'll have to wait until Q4 before you see that long-awaited rate cut. And even then, we're only expecting 125 basis point cut this year, and then a couple more next year. So for investors, they have to think, why would the Fed be moving in that direction? One of the reasons is that although there's been a slight downgrade to growth forecasts, there is still a lot of resilience within the US economy, which means that there is no major urgency to cut rates in the near term. And that should, I think, instill some confidence that there's going to be positive earnings growth in the future. And if there's positive earnings growth, well, then risk assets can continue to perform well. So from an asset allocation perspective, this is still the time to have exposure to equities, have exposure to credit, maybe with a slightly greater focus on quality assets, given there are some economic risks. But as I said, this is still a risk-on environment.
With that in mind, I wonder, because one of our viewers had actually tweeted this into us, or X posted it into us last week, talking about the key diversification that we've been talking about, but also trying to find the more resilient, surprising areas of the market. Have there been any surprisingly resilient trades that you've been watching investors really try to ensure that they're kind of ahead of the curve on right now, especially even within the diversification strategy that we continue to make sure that folks are educated and actionable on as well?
Yeah, I think one of the most surprising parts of the market, which has continued to outperform, has been gold. Coming into this year, there were real concerns that it was looking pretty frothy. But actually, as you've seen this increasing geopolitical tensions, as you've had concerns growing about the future of the US and the credibility of the institutions, gold has continued to do well. Now, from an asset allocation perspective, absolutely, I think investors should have some exposure to gold. There are other parts of the market that have maybe been surprising, but we think can continue to do well. One of them, for example, is high yield. When I think the worst expectations around recession were unfolding, there were real fears around high yield, and credit spreads did widen. As I said, we're still quite sanguine about the global outlook, about the US outlook in particular. So to us, this is an environment where high yield can do well, as long as you're focusing on those higher quality segments of high yield. But certainly, maybe if someone were to come in to look at the market, see some of the headlines, they would want exposure to high yield. We see it slightly differently and do think it's a good time to have that part of the market.
How do you kind of pair some of the investment strategy right now with, so much of the tariff policy uncertainty, and as we're getting closer to the deadline for the pause essentially expiring here, we're waiting to see which deals might actually come through the finish line. In the absence of those deals, though, how should investors be positioning themselves for a longer, perhaps protracted period of negotiation? And that could potentially mean modeling for a higher kind of net tariff rate or average tariff rate for a longer period of time.
Yeah, there is still very much elevated trade uncertainty, not as bad as it was a couple of months ago, but it is still quite elevated. Now, when we're looking out over the coming months and where these trade deals end, we do expect the average effective tariff rate to end up a little bit higher than even where it is today. So it's sitting at about 12.5% today. We expect it to increase to around 15%, and that's up from 2% at the beginning of this year. So that is a change in the global economic backdrop that everyone needs to take consideration of. But as you said, in the coming couple of weeks, we're going to be hearing news around the end of the 90-day trade truce and where tariffs are going to end up for a number of countries. In that kind of environment of uncertainty, it's really important investors maintain that global diversification. We've seen so far this year that the US hasn't been the best performer. They've been other markets. And I think that narrative continues. We do have exposure to US, but we like other parts of the world as well, segments of Latin America, parts of Asia, where we think that there is still that ability to perform pretty well given strong fundamentals and still attractive valuation. So the valuation story is still very much key for investors right now.
Seema, thank you so much for taking the time here with us this morning. Appreciate it.
Thanks.
Let's get to the three market movers that you need to watch for the trading day. Yahoo Finance's Jared Blickery has more. Hey, Jared.
Thank you, Brad. We are watching major indices. They are posting some gains this week, but it's been a choppy ride. And a reminder, we only have 4 days that we're trading this week in the U.S. And also, we're going to take out some of the weekly sector winners and losers. And then we'll take a look at the Dow and see how some of those components have led or lagged this week. But first, we'll start at the top here. And that's the interest rates. We'll get there in a second. But let's check out the S&P 500, up about 0.6% today. And if I check over the last 4 days, you can see as of the last trading day, Wednesday, we almost went into the red there just for a little bit. That was the big Fed day and the presser that we saw there. And but the net result for this week is up about 2/3%. Here is the Dow up about 0.5% today, and that's almost the exact same amount that it is up over these 4 days. And the Nasdaq Composite up 1.5%, so still posting some better gains excuse me, than the other markets we're looking at, the other majors. And also let's take a look at the S&P 600 for the small cap vibe, and that is up 0.9%, so almost 1 percentage point this week. And taking a look at the bond market, here's the 10-year T-note yield. We did see a bit of a dip before the Fed presser into that low that we're seeing here on the chart that I circled on Wednesday. It is up about 0.5 basis or 2 basis points today to 4.42%. Nothing to write home about. Here's the 30-year yield, and I'm going to show you the year-to-date chart so you can see how the interest rate has just kind of been meandering sideways to down for a little bit here. So just more choppy index there as well. And I almost forgot the VIX. Got to show you what's going on in the VIX volatility index as a gauge on potential fear in the market or institutional hedging pressure, as Steve Sosnick might correct me. That was inflecting up, and now we're heading back down. All this looks to me is right now as a choppy area. So we're just chopping around 18 to 21 or so. Nothing to write home about. Here's the sector action for today, communication services and discretionary leading, but I want to check on the weekly action. So here's communication services, tech and financials leading. Here's tech. I just want to show you this 1-year chart because it is right back up to record highs. It has been hitting some record highs as I've been talking about. Prior mornings hasn't really broken out though, so we need that catalyst to get tech to take that next leap. And then to the downside, we're tracking some defensive sectors. Healthcare has just had a really tough time this year, and here's a 1-year chart, kind of from the upper left to the lower right like that, down 0.9 over, or down 9% over that time period. And then let's finally take a look at the Dow. So you look at the mega caps here, those are solidly green for the week. Nvidia up 3%, Apple 3%. But the leader I'm looking at is JP Morgan, which is just about to hit record highs right now. So this kind of looks like that tech chart in a little bit of, in terms of that bull that we have here. Sometimes these form a little cup, and that would take a little bit more time. But JP Morgan looking for that next catalyst for the financials as well. And I should say that financials did very well on Wednesday after that FOMC presser. Finally, we got to take a look at J&J and McDonald's. I got to go real quick, but here's McDonald's. It was just kind of falling here. We punched through the 200-day moving average, not shown. Also this rising wedge, and so it fell pretty quickly this week. And if I show you the 4-day price action, you can see down about 4% over these 4 days here. On that note, I will send it back to you, Brad.
All right, Jared, thank you so much. Teeing up today's trading activity. Coming up, checking in on Kroger after its first quarter earnings. That's next. Shares of Kroger gaining nearly 6% after reporting earnings for the first quarter. The grocery giant beat the street's expectations on earnings per share, and revenue came in just shy of estimates at $45.1 billion. Kroger also raised its full-year sales forecast and reaffirmed the rest of its guidance. I want to bring in Bill Kirk, Roth Capital Partners Senior Research Analyst. He has a neutral rating and $58 price target on Kroger here. Great to have you here with us. So just take us into your analysis of this most recent quarter and how this measures up to your own expectations and what the company is saying about the outlook.
Sure. Thanks, Brad. So this was Kroger's best quarter for identical store sales in 2 years. And that's important because just a few months ago, Kroger had kind of cautioned that this quarter would be one of the softer periods throughout this year. So if this quarter, which was quite good, the beat that you kind of mentioned, if this quarter was the worst case for the year, that is a good worst first quarter, right? Relative to the rest of the year, things are expected to get better from here, and this was a great start. If you take a look at some of the kind of key metrics, obviously the ID sales were a 2-year high, but gross margin expanded, so gross profitability expanded, and their digital sales on e-commerce accelerated from where they were the last couple quarters.
You know, with that in mind, what does this spell out about the mindset of the consumer, at least through the lens of Kroger?
Yeah. So Kroger would benefit a lot if there was any sort of consumer stress, right? When an environment of consumer stress, shoppers shift from away from home consumption to at home consumption, right? It's a good way to save money. It's a quick, easy kind of benefit to your wallet. So where there's consumer stress, people might be shopping at grocery more, and you've seen their performance improve relative to competitors who sell less grocery. So it seems like the grocery side, the food at home side of the business is accelerating in this business and or in this environment, and Kroger sells a lot of that.
And so with this in mind, as we're continuing to think through food at home versus food away from home, and we got Kroger. We also got Darden to really sift through here. I guess, how are you evaluating where it's clear that consumers are saying, all right, let's stock up the pantry a little bit more, perhaps pulling back from some of the food away from home, but also being extremely selective if they do go out to one of the Darden capacities? And I know that's not a company that you cover, but how is that decision tree really playing out between two entities of these types?
Yeah, so we saw in February in particular, restaurant traffic take a deceleration. So restaurant traffic decelerated dramatically in February. And for Kroger, this period goes through May. So you have some of that kind of decelerated restaurant performance in this period that Kroger reported, likely to Kroger's benefit. I think the primary variable here is where Walmart sits in this space. Walmart's 25% of grocery sales, and Kroger, about 52% or so of Kroger stores share a zip code with Walmart. So they overlap very, very heavily with Walmart. And in times of consumer stress, Walmart likes to lean into their value offering, right? Walmart offers some of the lowest prices. So when there is, or if there is consumer stress out there, Walmart is who to watch and what they do with prices, because it impacts everyone, from Kroger to Target to Albertsons. But they are the leader, and in times like this, they've been known to lean into that value that they provide.
Would there be any overly exposed aisles of the grocery store, whether that be at Walmart, whether that be at Kroger, whether that be even at some of the buy in bulk wholesale companies out there? I think about Costco, I think about Sam's Club as well, subsidiary of Walmart and BJ's. Are there any aisles that are most exposed to us not getting any type of deals on tariffs coming through in the coming weeks?
Sure. So the most exposed would be those who sell the most general merchandise. So from China in particular, Kroger probably only gets 2-3% of its product, versus someone like Target who's over 30%. Walmart's probably in the high teens or so. So the exposure to tariff is much more pronounced at Walmart and most pronounced at Target. And Kroger and the grocery stores like Albertsons are relatively insulated. There's some seasonal produce that might come from a country that doesn't have a tariff deal. But generally speaking, the grocers are among the most insulated because they sell necessities, right? They sell things people need, they need to eat. And also a lot of the product doesn't have tariff implications on it to begin with.
Bill, good to have this conversation with you. Thanks so much for taking the time today.
Of course.
We've got all your markets action ahead. Stay tuned. You're watching Morning Brief. SpaceX's Starship rocket exploded late Wednesday, marking another setback for Elon Musk's ambitious space program. The company says a major anomaly occurred as the rocket was preparing for its 10th flight test at SpaceX's launch site in Texas. The explosion ignited several fires at the test site, according to SpaceX. It's the fourth time this year the company lost a Starship vehicle, although previous failures happened during flight and not during ground preparation. SpaceX posted on social media that all personnel are safe and accounted for, and that there were no hazards to residents in the surrounding communities. Engineering teams are investigating the incident. An initial analysis indicates a potential failure of a tank that holds nitrogen gas. NASA has awarded billions of dollars to SpaceX for Starship development, which plays a central role in the space agency's program to return astronauts to the moon. Elon Musk has acknowledged the technical issues and challenges of Starship, which is the largest rocket ever built, standing at just over 400 feet tall. The latest setback comes as Musk recommits his time to companies after ending an advisory role in President Trump's administration. Tensions between the two escalated when Trump threatened to cancel all federal contracts held by Musk's companies. Musk retaliated, saying he'd cut off NASA's access to SpaceX's Dragon spacecraft, which the agency relies on to fly its astronauts to the International Space Station. While the feud has cooled, the incident highlights the government's reliance on SpaceX to maintain leadership in the space industry. That does it for the Morning Brief. You can join me in the next hour for more on Catalyst. We've got much more market action left and coming your way.